slippages were the only point of contention in the bank. Otherwise, very strong NII growth and profits and margins, something that the street liked. Joining me now is Sumant Kathpalia, the Managing Director and CEO of IndusInd Bank. Sumant, thank you very much indeed for joining us. Very good growth in margins. I mean, the fact that the margins were flat has surprised a lot of people. Can you tell us how things will pan out? Because there is a war out there for deposits.
Yeah, absolutely. Good morning, Latha, and you're absolutely right. I think we've been able to maintain our margins. If you look at for the last 4 quarters, we've been at 4.2 to 4.3, and we continue to give that guidance that we will be between 4.2 to 4.3. Our margins have been steady at 4.29, and I think we have a lot of levers. I think it's the mix change in our between corporate and retail, number one, and within retail, we have a mix change between microfinance, vehicle finance, and the other assets. So I think that's what has helped us maintain the margins. And also, we also believe that our cost of deposits and cost of funds, which were growing very rapidly, have now slowed down, and it's only grown by 9 basis points. And we believe that we should be able to manage that as we go along. And I think maybe another quarter of growth, and then you should see a steady cost of funds as we go forward.
Okay. Well, since you know at least a few weeks of the current quarter, can you tell us whether the cost of deposits, cost of funds will rise a bit? By how much might it rise? After all, RBI is still on a tight policy mode, tight finance mode.
So I think as long as there is a migration of deposits to term deposits, I think the cost of deposits will see a rise. I think how we manage it is because of cost of funds, and I think we have a very significant way because of our borrowings where we get refinanced from developmental associations, and we are able to manage our cost of funds in a better way. And I think we have long-term funds which come at very attractive cost because of the portfolios which we have. So I think while there may be an increase this quarter, I think you will only see stabilization of that as we move forward.
Okay. Well, now let me come to the only other problem that your investors may have with you, and that is slippages. That was elevated, 2.6% annualized and higher quarter on quarter as well. Can you guide something about slippages for the current and next quarter, likely to come down, stay there?
So Radha, first of all, our guidance has always been on credit cost. And if you look at our credit cost, the credit cost has come down from 157 basis points to 119 basis points. So we are well in line with our guidance on the credit cost between 110 basis points to 130. Of course, during the quarter, intra-quarter or within the year, there may be some quarters where you will see elevated gross flows. That doesn't mean our credit cost will change. We've already seen our gross flows coming down for this quarter, and I think you would see the gross flows coming down dramatically and within the range bound which we've been between 1100 to 1400, and that's what we will be in the gross flows. And I think our credit cost will always be between 110 to 130 basis points.
Okay. No, the credit cost was also managed because you used up the contingency buffer. Without that, it could have gone higher, and that's why I'm asking. Now you don't have that buffer anymore. So, how will the subsequent quarters behave? Will you still be able to control?
So we have still got the buffer.
Go ahead.
So our credit cost will be within the range of 110 to 130. We still have the contingency buffer. We've been saying that one of the stressed accounts where we have provided will get released, and I think we will use that contingency buffer as a buffer and keep it aside for ourselves in the long run. But we still have the buffer of 1300 crores. So to say that we don't have the buffer, and we are still provided at 2.22% of the loan book. Having said that, I agree that the gross flows should come down, and I think the gross flows came in from vehicle finance, and I think you're already seeing a recovery in the vehicle finance. It came from 2 areas. One is the south and the other is the north. North because of the freight movement because of fog, and in the south because of some flood situation. But I think we're already seeing a recovery there. I think the agri piece, it's a seasonal, cyclical view, and we are seeing that recovery also happening. So I think you should see us down dramatically this quarter on the gross flows, and we should settle down at the gross flows of about 1100 to 1300 and a credit cost between 800 to 900 crores as we move forward.
Okay. Can you just guide on margins? 4.29 is doable or it gets chipped off a bit?
I've always said it'll be 4.2 to 4.3. Very difficult to give a number to a margin because it depends on your cost of funds and the yields and how the mix progresses. So we've always said it will be between 4.2 to 4.3. If any historical trend is to go by, we've always maintained above 4.25%.
Okay, no, I mean 4.2 to 4.3 is as good a guidance as any investor can want. No one wants the second decimal point. Okay, can you talk to us about MFIs? Did they give you any problems, your microfinance unit, or was it all rosy? Because some other standalone MFIs have not done too well. Results came over the weekend. How's yours doing?
So our MFI business continues to grow, and I think we've diversified the business. So if you look at our business now, 85% of our book is JLG, which is the joint liability group, and 15% is merchant acquiring, where we have a 4,700 crore book, which is the small merchant acquiring business which we've created, and to diversify the book. On the JLG book, I think we are growing at 20% CAGR. We've lost market share in that business because we've exited some of the states which we thought, or slowed down some of the states where we thought over leveraging was happening. I think our flows are anywhere between 2.5% to 3%, which is 50 net flows between 55 basis. But that's where our credit cost will always be in the MFI. I don't think an MFI business can run at 100 to 120 basis points. I've been saying it. It's not advisable to accept to have that guidance. I think we will always be at 2.5% to 3% credit cost on the MFI business, and this quarter we were at 55 basis points net flow.
Okay, yeah, that's true. I mean, that's a fair point about MFI as a business. Your retail book, both in terms of deposits and in terms of loans, has done very well. Can you give us a little more guidance in terms of how it's doing? You just told me that vehicle book, despite the problems, is showing a sign of recovery. Can you give us more nuances about how the retail book did and will do?
So I think our CFD, which is vehicle finance book, is very well diversified. We have an 87,000 crore book which we've reported. It's about 26% of our book. It comes at a yield about 12.6% and a credit cost of about 1.3%. It will go down to 1% as we go along. This year we will end at 1.18% credit cost on that book. I believe that the book diversification has really helped us. Our book is now diversified into 6 vehicle categories. MHCV, which was the large portion of our book, is now only 20% of our book. The LCV part has now become a very large book. We have car, we've got a 4% market share in new cars as well as used cars. We've tractors, we've got two-wheeler loans, and we've got construction equipment. Okay. So I think this book is now very well diversified, no concentration risk on the book. I think we saw some flows coming in the MHCV segment, but we believe that it will get stabilized. The growth in the MHCV segment did suffer last quarter, but in spite of the growth being lower, I think we were able to show a very large disbursement and a 20% growth on this book.
Okay. Fee income has been weak.
The other part is there anything?
Sorry, I mean, can you get to fee income? Anything that you're doing to strengthen that? Because that was a weak one. So, no, I think our fee income was between 1.8 to 2%, and that's what we've said, that it will always be between 1.8 to 2%, and 69 to 70% of our fee income comes from consumer bank. So I think the corporate bank fee is going to be subdued, and I don't think we have investment banking fee anymore. So that's where the issue is, and I think our fees will continue to fluctuate between 1.8 to 2% of the assets. Okay. Will you be looking to raise capital? The market is in a kind mood. As we've said before, we are well capitalized as of now. Yes. We will, I said that 3 quarters ago also, that we will evaluate quarters after 6 to 8 quarters. And I think the 3rd quarter of this year is when we will evaluate whether we need capital or not. As of today, I think we're well capitalized and our internal accrual should be enough to meet the growth. Even if you look at our RWAs, if you take out the unsecured 30 basis points which we've added for the risk-weighted assets,
our risk-weighted assets on the corporate book has shown a decline, and we would have accreted capital on that book rather than reduced capital. So I think we've used our capital judicially, and we will continue to use it judicially.
Okay, I'm out of time, but a very quick question. Did RBI speak about the CD ratio, and what is the goal you're working to for the current quarter? They've spoken to everyone.
So we are at 86 to 90%, and that's what our range has been for a long time, and we will continue to be at 86 to 90%. RBI has not talked to us about the CD ratio. I think we've always been well within our means on the CD ratio.
Okay. Fair enough. Yeah, 86 is, or 80 is not something that one should worry about. Thank you very much, Sumant Kathpalia, and congratulations once again. When your results came up, it did help the banking sector. But today, of course, things are all a bit under the weather. Thank you very much for joining us.